Welcome to DeWitt Dunn Financial Services with your host, Cathy DeWitt Dunn.
And welcome back. I'm Cathy DeWitt Dunn along with Steve Ringo. Thank you so much for joining our show. I cannot believe it. 55 years ago this week, the Beach Boys released I Get Around. Although they had a lot of hits before, I Get Around was their first #1 U.S. hit. I can't believe it. 55 years ago. That's
Awesome.
Some great music right there.
Definitely is.
Yeah, well, we're so glad that you've joined our show today. Actually, you know, being on the air for so many different years, I would have to say this is almost like a market alert show because the market has been so volatile because of everything with China. And, you know, things come and go. Things are stated. You know, there's resolution, then there's conflict. But I think the thing that Steve and I would like to try to get across to you today is that you don't have to have your retirement in jeopardy based upon what's happening with the market. That's just not the way you should approach retirement. And we're going to talk to you today about some great ways to preserve your assets, grow them safely, and not have to worry about it. Because, you know, if you remember, like on Thursday and Friday, our phones were just ringing off the hook. That's not what investing in retirement should look like.
Yeah, and it kind of goes back to that article that I sent you earlier in the week. It's crazy that one comment can shift the market so quickly. So I was kind of doing some thinking about, you know, in previous years prior to technology, prior to us getting information at such lightning speed, what happened? People didn't worry about it because they were doing other things. So now, as we get closer to retirement and with the technological advancements that have happened, you can't be in the traditional buy, hold, and pray type of strategy. You have to have a portion of your assets in something that's going to be protected, but also has the upside potential. And that's exactly what we're going to talk about in today's show here at DeWitt Dunn.
You know, that's pretty interesting that you should say that, Steve, because actually the Dow recently broke through record territory, right? Last October. That's last October. This is May, right? May. But Blackstone CEO Steven Schwartzman tells CNBC that he's expecting the markets to start cooling off. Let's listen to what he has to say.
I would say we've had a good run. It's at a pretty good level. The idea that we're going to, you know, sort of keep increasing at the same rate doesn't make a lot of sense to me.
And the challenge for the investor is that this market has been phenomenal over the last decade almost. What are you going to do? The market is not going to continue to go up the way that it has over the last 10 years. Why do you want to have your money at risk? But also, you can't be sitting at zero because there's so much money right now sitting in CDs, money markets, fixed income. How many people are buying bonds? It was pretty interesting this past week. Somebody said, yeah, I shift all my, you know, money into bonds. And I was like, well, what are the term? Well, I don't know. They just put me in bonds. I'm like, and they came in and I was like, wow, a 20-year bond. I'm like, they had no idea.
Right, and a lot of people don't also know that when interest rates are at an all-time low, that's the worst time to get into a bond because as you know, and as some of our listeners know, as interest rates begin to rise, which will happen at some point in the future, the value of that bond actually goes down. So the limited growth that you have on it, the limited accessibility to the funds is not what you want for your retirement plan. And that's been the challenge, right? Because people that do understand that will traditionally keep their money in equities. Well, that's a risk position. The closer you get to retirement, you should have less of your money at risk. And the strategies that we talk about give you the ability to participate in market upside while still preserving your principal.
And that's a great point, Steve. If you also take a look on our website, I recently had the opportunity to sit down with Roger Ibbotson. He wrote a white paper that we could send over to you if you call us 972-473-4700. Again, that's 972-473-4700. And his white paper talks about how the fixed indexed annuities outperform the bond market. And who's Roger Ibbotson? He's just a famous economist, very well written, read, Harvard, Yale, has all the credentials. And he did a comparison on bonds versus fixed index annuities. and they've outperformed the market. We also, on our website at DeWitt Dunn, if you go onto our homepage and just scroll down to the bottom, we have an actuary, Dan Slater, that has actually talked, and we had him on our radio show talking about replacing the current fixed income allocation with a fixed indexed annuity, and also one that doesn't have any fee. And it's just very interesting that everybody's coming out. And yes, I know people think that annuities are horrible. Variable annuities are, but you have to look at the different kinds of annuities that are available out there. And just because one asset class or one particular variety of an annuity doesn't mean they're all bad. 403B is an annuity. The lottery payment that you would receive on an annual basis, that's an annuity. Social Security is an annuity. A pension is an annuity. How about an annuity for income? I mean, all those other options are giving you income, and you've got to have income and more income when you're going through retirement because of medical costs. And right now, future and the volatility in the market, Steve.
Right. And speaking of income, I had a young 62-year-old come in, had $750,000 in their IRA that they were looking at generating a guaranteed lifetime income stream. So right off the bat, the client is credited with a 7% bonus. So $750,000 turned into a little over $800,000. So $802,500, but you leave that in deferral for a 10-year period of time, which was when they wanted to start taking that income, and that money more than doubled. But what we like about this is that guaranteed lifetime income stream, guaranteed almost $95,000 for the rest of that person's life. Right? And that's going into a point in time where we don't know what's going to happen in the next 10 years. We know what's happened the previous 10 years. The market's gone straight up. We're in the second longest bull run, or the second largest bull run in the previous 10 years. So we need to have a portion of our portfolio allocated into something that's going to give us some predictable income and even some upside potential.
And I think that's great. And that strategy has really done well for our clients. And I don't care how much money you have or what positions you think you need to have in the equities, whether it's, exchange traded funds, stocks, bonds, mutual funds, you have to have an asset class that's going to give you guaranteed income.
Exactly.
Right.
And you talk about that. You build the foundation on guarantees, and then you take necessary risk after that. This person put $750,000 in this guaranteed lifetime income stream, but we had another $500,000 go into the managed money side that Laura heads up, and that's going to give more upside potential while still working on preserving the principal.
And if you would like to schedule an appointment for us, great news. We have offices in Dallas, Fort Worth, Arlington. Boy, I love our new Arlington location.
Awesome.
In Houston, Texas, the number to reach us today is 972-473-4700. That's 972-473-4700. Or if you're looking at us right now online, you can go to our website, all this social media stuff and how they're, y'all are doing a great job. But it's a little difficult for me. But you could go to DeWittandDunn.com, find out more about us. You can see all of our videos, download our white papers, find out more information. If you're 59 and a half, currently contributing to your 401k plan, it's pretty interesting. There was a recent article that indicated that most plans, because you're contributing to your 401k, and the returns, just the return, not your contribution or the matching, on average, those returns are only 2 to 3% per year. Per year. So if you're over the age of 59 and a half, you need to roll those funds over because, as you know, you may not remember, but July of 2017, the Department of Labor started attaching additional fees to those 401k plans, and you could roll that out. And just imagine if you got rid of the fees. I mean, right there, your return's already going to go up. If you have IRAs all over the place, we have a lot of clients that have contributed throughout the years, and they've gathered their statements. We've consolidated. We put everything together. We'd love to help you with that. If you have old annuities, if you've not heard from your advisor, or you have variable annuities, or I actually met with somebody the other day that had an annuity from 1989. I don't think they like change, but we were able to roll that over. They didn't have to pay taxes on those gains because it was a 1035 exchange and it was not an IRA format. So we were able to defer the taxes on that. Also, if you have inherited IRAs or inherited non-qualified annuities, if you have an estate and you're looking to preserve and grow that, or a 501c, we've sat down with so many people here recently and put a plan in place for them, and we'd love to sit down with you.